Most people are staring at silver's price on a screen right now, trying to understand why it feels unstable. But the real shift is not happening on Western trading desks. It is happening quietly in Asia, and it starts with policy, not price. This change in focus is critical for understanding what comes next. China has just changed the rules of the silver market again. This time the timing matters more than most people realize. This is not a routine adjustment, and it is not isolated. What happens next could reshape how silver trades globally, especially once Asian markets open. Before reacting emotionally, let's slow this down and look at what is actually happening, because recent price action alone does not tell the full story. Yes, silver sold off hard in another familiar Friday move, with prices dropping more than 3% and briefly touching the high 80s before rebounding. Moves like this are uncomfortable, especially for traders, but Friday action rarely defines direction, and the real signal usually comes when Asia opens, and this Sunday night is different. Starting January 19th, 2026, the Shanghai Futures Exchange is enforcing new intraday position limits on silver futures. These rules directly restrict how much exposure traders can open within a single session. That matters because Shanghai is far more connected to physical silver than Western paper markets. Silver does not trade the same way everywhere, and the structure of each market changes how stress appears. In the United States, futures markets are largely driven by leverage and paper contracts, while in Shanghai trading is much closer to real metal, real delivery, and real supply pressure. When Shanghai tightens conditions, it is usually responding to physical stress, not chart patterns. Here is why the timing is critical, because these changes are stacking on top of each other. At the start of January, China implemented new restrictions on physical silver exports, which alone tightened availability inside the country. Now, on top of that, Shanghai is cutting intraday opening limits from 7,000 contracts down to 3,000, a reduction of more than 50% that is not cosmetic but defensive. Volatility is already elevated, physical demand is strong, and price discovery between East and West is no longer aligned. Inside China, silver has been trading at significant premiums to Western spot prices. In some cases, physical transactions imply prices well above $100 an ounce, which is not theory but metal changing hands. Large silver bars are being purchased and moved physically, and that behavior does not appear in calm, balanced markets. It signals urgency, not speculation. When export restrictions tightened at the beginning of the month, futures volumes surged, premiums expanded, and volatility followed, making the market look disorderly from Shanghai's perspective. Officially, exchanges frame these moves as efforts to maintain orderly trading, and that explanation is not wrong but incomplete. When supply is tight, restricting futures activity often increases stress rather than calming it. Liquidity thins out, price moves become sharper, and panic behavior replaces smooth trading. Silver is especially vulnerable to this dynamic because it is already in a structural deficit. Industrial demand continues to grow, with energy, electronics, and technology all requiring silver regardless of price. Mine supply has not responded meaningfully. New production takes years, and above-ground inventories are being drawn down. Paper mechanisms can mask that reality for a while. They cannot eliminate it. Eventually, physical constraints reassert themselves. Now consider what happens next, because pressure does not disappear when rules tighten. When Shanghai restricts trading, speculative and hedging activity does not vanish but migrates, with much of it flowing toward Western futures markets. That shift is already visible, with open interest in U.S. silver futures up roughly 20% year over year. The CME has responded by increasing margin requirements based on notional value, which on the surface looks prudent. In practice, it creates nonlinear stress because as prices rise, margins rise. Weak hands are forced out, strong hands remain, and this often purifies bull markets rather than ending them. Despite repeated margin increases, silver has not collapsed, but has corrected, stabilized, and continued higher. That tells you something important about the nature of this move. This market is not being driven purely by leverage, but by real demand colliding with limited supply. Here is where the risk concentrates, because Western futures markets are not built for sustained physical stress. They assume most contracts will never stand for delivery, and that assumption holds only until incentives change. When physical shortages appear elsewhere, delivery suddenly matters. East-west price divergence increases arbitrage pressure, and inventories in London and New York are not infinite. Moving metal across regions takes time. If enough pressure builds, exchanges face a choice to allow price to rise to ration demand or intervene more aggressively. History shows that intervention has limits. Those limits become visible during periods of sustained physical stress. Silver markets are now approaching that zone. This cycle already looks different from previous silver spikes. It has lasted longer, absorbed volatility, and survived margin hikes. That suggests a structural move rather than a short-lived mania. Now, let's talk about expectations, because perception is already shifting. Silver is no longer trading at levels that would have seemed plausible a year ago. Prices in the high 80s and low 90s have become normalized, which alone confirms that repricing has occurred. From here, there are only a few realistic paths forward. One possibility is a sharp spike followed by a violent pullback as leverage is flushed out, while another is consolidation at higher levels, where former resistance becomes a new base. The third, and least discussed outcome, is a structural break where price behavior changes entirely as physical stress overwhelms policy tools. Which path unfolds depends on supply, not sentiment. Exchanges can adjust margins and limit positions. They cannot create metal. Silver remains in deficit, demand is sticky, and inventories are finite. That means price must eventually do the work. Volatility in this environment is not a warning sign, but confirmation. This is not a market that looks exhausted. It looks like a market entering its most unstable phase. Bull markets do not end because prices are high, but when fundamentals improve, and nothing on the supply side of silver has improved. As Asia opens, and these new rules take effect, expect movement, noise, and emotion. Pressure reveals truth. We are about to see how resilient this silver market really is. The question is not whether volatility increases. That outcome is already clear. The real question is where that volatility breaks next.
Hello my dear friends, how are you? I hope you fine. So friend, most people are staring at silver's price on a screen right now, trying to understand why it feels unstable, but the real shift is not happening on western trading desks. It is happening quality in Asia, and it starts with policy, not price. This is change in focus is critical for understanding what come next. China is just changing the rules of the silver market again, and this time the timing matters more than most people realize. This is not a routine adjustment, and it is not isolated. What happens next called reshapes how silver trades globally, and once again once again market open before reacting emotionally. Let's slow this down and look at what is actually happening, because recent price action alone does not tell the full story. So friend, yes, silver sold off hard in another familiar Friday move. So friend, I hope you will enjoy, you will entertain, and this video you will educated. So please like this video and subscribe my channel. Thank you so much my dear friends.